Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, November 17th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we do have futures down. It is options expiration week. As I mentioned to members at Earnings Beats earlier this week, there was the tendency, or at least we should expect, in the short term, maybe a little bit of a pullback simply because the big rally that we saw last week and into the early part of this week created a situation where there were a lot of in-the-money calls as we head toward options expiration week. That can negatively influence the market in the very near term. So I'm kind of taking the weakness this week with a grain of salt, kind of expected a little bit of downside action, personally using it to build a long position. Let's go ahead and take a look at today's agenda. So we're going to start off today with the daily market recap, then talking technically, sentiment update. This is maybe surprise some of you if you haven't been watching the equity only put call ratio, but we'll talk about the sentiment update there. Then earnings spotlight, and we'll wrap up the show with the 3 you must see. Before we get into any of that, I do want to take everyone over to Earnings Beats. A couple of announcements here. First of all, this is our biggest event of the quarter tonight. I talk every once in a while about our portfolios, and you can see our model portfolio since 2018 has more than doubled the S&P 500. It's been up about 2.4 times what the S&P 500 has done. Our portfolios, what we do is every 90 days, every 3 months, we restock them with 10 equal weighted leading stocks in leading industry groups. That's the whole idea. And we put this together trying to beat the S&P 500 each quarter. You know how difficult it is for portfolio managers just to beat the S&P 500 over the year. We try to beat it every quarter. And we've done it. Well, we've got 2 more days before this quarter ends, but it looks like the model portfolio will outperform for the 10th time in the last 16 quarters. That's pretty strong when you consider a lot of professionals can't do it on an annual basis, and we've done it 10 out of 16 quarters. Well, tonight we will be having what I like to call our draft. When you think about it, if you're an NFL fan, you got all these general managers and teams putting together their collective thoughts, trying to figure out which players to draft. And of course, once a player's been drafted, it's off the table. You can only draft from the unselected players. Think about the stock market for a minute. When you go to put a portfolio together, you don't have to worry about what everyone else is picking. You can pick however many stocks you want. You can pick leaders. You can pick the best of the best. It's like drafting your football team with a bunch of all-stars. Imagine having the first 10 picks of the NFL draft. Probably could build a pretty good team pretty quickly. Same thing goes with the stock market. If you're able to put the best stocks in your portfolio, you ought to be able to beat the S&P 500, and that's what we do. That event starts tonight at 5:30. It is a member-only event. What I do is I go through and I talk about the themes, the reasons why I pick the stocks that I pick. I look at the market outlook. I'm trying to figure out where I think the market's going, what's going to lead, what are the key reasons behind what I think is going to lead. And then we actually go through and talk about the stocks that have been selected into each of our 3 portfolios. We have a model portfolio, an aggressive portfolio, and an income portfolio. So all of that takes place today at 5:30. If you want to attend, we have a 30-day free trial. All you have to do is click on this to get your 30-day free trial started. At the end of 30 days, if you're not interested, we will reach out to you. We'll say, hey, your trial is coming to an end. Do you want to re-up? Here are your choices, annual, monthly, whatever. We're not just going to let it, let the 30 days quietly go by so that you get your credit card hit. We want you to be a member if you want to be a member. If you'd like to be a member, try our service, come to this event tonight. Click on that button there to start your no-cost trial. It's a great time to try us because we just started last Saturday our fall special, which will run for 2 weeks. So if you start a trial now, you get an opportunity to see what the service is all about before you need to make a decision about the fall special. But we have a great sale going on. This is our best deal of the year. If you like our service, the longer you commit, the more free time we give you. It's a great special. Many of our members, I probably would maybe could say most of our members have signed up using our specials in the past. All right, let's go ahead and move on to the daily market recap. So on, excuse me, on Wednesday, we had the Dow Jones Industrial Average down 39, S&P down 33, NASDAQ down 175. On a percentage basis, getting hit the hardest. Of course, most of those NASDAQ stocks are the ones that have a lot of in-the-money call premium, much more so than the S&P and the Dow. So as a result, I would expect this week to be a little bit rougher on the NASDAQ. It's interesting, though, because interest rates have been coming down. That normally would spur NASDAQ stocks to be bought. I find it very interesting. Option expiration week, all of a sudden, that's not working. We'll see if they catch up at the end of the week or into next week. Anyhow, mid caps down 1.5%, small caps down about 1.7%. Everything, from a configuration standpoint in the charts, I think looks pretty bullish. All the PPOs now have turned positive. All of the AD lines are at or near highs for the year. Price action is above the 20-day, which is above the 50 on all the major indices except the NASDAQ. And you can see the NASDAQ, the 20s coming up. We'll see what happens here over the course of the next week or so with options expiring. But I believe once you see the NASDAQ turn back to the upside, I think you're going to get that golden cross. And then we'll have all of our major indices pointing in the same direction. From a sector perspective yesterday, utilities and consumer staples led, which is not unusual when the market goes down. These are two defensive groups. That's where we normally see leadership. The utilities trying to strengthen off of the lows that were set back in the month of October. You can see we've been in a pretty nice pattern here. Still got some work to do to getting above the moving averages and getting that 20-day to cross above the 50. Staples, on the other hand, have definitely rebounded a little bit better. Price action is set up. Configuration here is much more bullish. As far as the groups that did not perform well yesterday, energy, which was down more than 2%. This has been a really strong group, but I have been pointing out negative divergence here, along with the recently high price up near 95. I said maybe we'd get a pullback. I wouldn't be surprised maybe if energy were to pull all the way back into the 80s and get closer to that rising 50-day moving average. Discretionary down 1.5%, technology down 1.4%. Both of these groups, I think, highly subject to options this week, especially technology. Last week, we had such a big run to the upside in the semiconductors and in software. Both of those tend to see a lot of option activity. And as a result, we're seeing some pullbacks in those areas of the market. 10-year Treasury yield. So yesterday went down 10 basis points, 11 basis points to 3.69%. This is what I was talking about. If you look, I'm going to change this chart down here. I'm going to pull up the QQQ and the spider. And then we'll just get rid of this other one. Don't need it right now. So if we just look at what the 10-year Treasury yield has done, and we look at what the relative performance of the QQQ, which is the NASDAQ 100 ETF, versus the spider, which is the S&P 500 ETF, look at the relationship of the NASDAQ 100 versus the S&P 500. It's been going down, and it's been going down for good reason. That ratio has been going down because interest rates have been going up. As interest rates go up, valuations on high growth areas come down much faster than value-oriented areas of the market. Why? Because earnings growth is forecast to be much stronger on companies that earn, that are showing strong earnings, those growth-oriented companies. When you get interest rates that are going up, we take those rates and we discount those future earnings back using interest rates. The higher the current rate is, the less those future earnings are worth. The lower the interest rate, then the valuation is off the charts to the upside. So if you look at when we make these big moves to the upside, look at how the growth performs. It underperforms. When rates were coming down back in June and July into early August, What happened to the NASDAQ stocks? They spiked. Then once we bottomed and we started seeing the 10-year Treasury yield move higher again, there goes the relationship again to the downside. NASDAQ stocks underperforming. What I find interesting here is the last couple of days, we started going down. You can see growth starting to pick up. But these last couple of days, we've seen a lot of folks moving into bonds, sending the yields down. So we should be seeing that continuing move to the upside in the QQQ, right? Nope, not happening. Why are we going back down? Well, I'll give you my theory. It's opposite George week. That's a Seinfeld reference for those of you who watch the show. Remember George Costanza, down on himself, always making the wrong choices? There was an episode where Jerry Seinfeld tells George, listen, if every time you make a decision, it's the wrong one, why don't you just start doing whatever is the opposite? And so he starts to change everything. It's a pretty funny episode. I'm not going to go into it, but he starts doing the opposite and his whole life changes. Well, if you start doing the opposite with the stock market for options expiration week, I think your trading will improve. And so my reasoning for the yield going down and all of a sudden this turning back down is the fact that it's opposite George week. Do you want to see over the course of the last week what's been leading the stock market? So we have technology, communication services, consumer discretionary. Here's real estate. Look at these top 5 groups for over the last week. Look at their scooters. This is their StockCharts technical rank, which is a relative strength calculation formula. But if you look, the weakest groups have been the strongest over the last week. And if you look down here, the strongest groups have been the weakest. We see this just about every month. I point it out just about every month. You got to know, last week, going into Thursday, last Thursday, the CPI report for October came out last Thursday morning. As we headed into that, we had a ton of in-the-money puts. And those in-the-money puts were centered around these 3 groups. And so when Thursday and Friday hit last week, we had an explosion to the upside. And that's why these groups have been leading. But the moves, because they've just been in the short term, we haven't seen a whole lot of movement here in the scooters just yet. Technology, we've seen it pick up some. But these groups have been moving up. But technology went up so fast that it actually went beyond max pain and went about, I don't know about technology, but I know the QQQ is about 4 or 5% above its max pain level. And the max pain level is the point at which market makers pay out the least amount of premium on options. Let me say that again. Max pain is the point at which market makers, which take the other side of many of these options trades, it's the point at which they pay out the least amount of money. Don't you think that they would like to get to that level where they pay out the least amount of money? Remember, this is a short-term phenomenon. Once Friday's gone, there's a little bit of carryover into the following week, but for the most part, once Friday's gone, options have expired, market's free to do whatever it wants. But this is one of those periods when you head toward options expiration that I believe you have a lot of manipulation in the market. And I think that's what we've been seeing taking place. So technology, if you've looked the last couple of days, it hasn't been performing as well. I mean, if we just pull up the intraday, one day, you can see technology, consumer discretionary, and energy. Energy has been a very strong group. Technology has been a very strong group for the last week, meaning now there's more option expiration manipulation, perhaps, in that group as we close out the week. That was actually one of the groups that lost more than 1% yesterday. Anyhow, I just find it always fascinating, option expiration week. Let's keep moving. S&P 500. Here, talking technically, you've got the S&P 500 breaking out recently last Thursday again with that CPI report. Last couple of days, we've been struggling just a little bit. I'm not surprised, though. Again, and we got futures down today. I didn't even give you the futures, but right now I got futures down 252 on the Dow, 35 on the S&P, and 107 on the NASDAQ. All close to 1%, between 0.75% and 1%. But that's bringing us down closer to max pain. Am I surprised? No, I'm not surprised at all. I think the S&P 500 has great Gap support down around 30. Well, I can give you the exact number. That's at 38.60, basically. We also have 3,900, which we cleared. That's been a major pivot area. So I think to the downside, watch 3,900, watch 38.60, and the 20-day moving average rising up from underneath 38.54 right now. So I think you've got a pretty good area of support on the S&P 500 from about 38.50 to 3,900. So if we keep selling off here this week, or maybe even into the early part of next week, I would look for that area to hold. So my philosophy, as I said earlier, I'm building long positions. I'm doing it into weakness, anticipating with options expiration that I'll be able to get some prices cheaper. NASDAQ 100, same deal. There's your Thursday gap up. As far as what you should be looking for in terms of support, that open from last Thursday was 11,350 on the NDX. The 20-day moving average right now, 11,369 versus 11,350 gap support. You got the 50-day coming in 11,415. So you got a lot of support. If we go down another, let's say 275 points to maybe 325 points, 350 points, somewhere in that range, which would be another 3% or so. So if we were to fall back another 3% or so, that would really start to look intriguing to me from the long perspective. Let's move on to the sentiment update. I really want to go through this and talk through this for a minute. So what I've done and what I talked about back at Market Vision 2022, that was our annual event that we host normally right around the first Saturday of the month. This year, by the way, if you want to mark your calendar, Saturday, January 7th. So what I looked at last January, you can see this 253-day moving average of the equity only put call ratio just starting to turn up. And I've had people ask, well, why are you using a year? That seems like a lagging indicator. Well, it is, but sentiment is something that goes through periods of change. You get periods where you're extremely bullish. You have other periods where you're extremely bearish. And the impact it has on the stock market is undeniable. Undeniable. And I'm going to show you what I'm talking about. I'm going to annotate this chart. I'm going to use the vertical lines. When we get to peaks, that means the number of equity puts has just been off the charts versus equity calls. That means the market's getting very, very pessimistic. So what I'll do here is I will use the red dotted lines to mark, and I'll do it lighter so we can see it, just have it there in the background, to mark the peaks. So every one of these key peaks I will mark. And then I will use the green vertical line to mark all the bottoms. And we're going to look at the S&P 500 to see what happens. I'll use this ultimate bottom. Okay. So here, the green is the sign that, hey, wait a minute. I got the colors backwards. I'm sorry. When you're going down, this is a red warning sign. This is going to be, these are going to be red. My bad. And the reason that the bottoms are going to be bad, that's when you've had so many calls that there are no more buyers left. So let's go ahead and change this. I think it'll just be easier. So the bottoms are red. Excuse me. Wait a minute. I'm confusing myself here. So when you're going down, you're getting very bullish. That's a warning sign for the market. The tops where you are very bearish, once you reach maximum bearish levels and you start to roll over, this normally is going to be bullish. So we'll go ahead and mark these as green. I should have had this all done before we started the show. Yeah, so then this one down here would be red. There. Okay. So the whole idea here is that when the equity only put call ratio is dropping, that means more calls are being played. It's equity puts divided by equity calls. So the relationship, the fraction gets much lower when the numerator puts is smaller compared to the denominator, which is calls. That's what sends this down. So after 253 days, this is a 253-day moving average. I call it the Freightliner of sentiment, because you can see we don't do a whole lot of turning back and forth. When we finally roll over, it's usually a major sign. Now, I want you to look down here. When we hit these key bottoms, the red dotted lines, I'm going to show you how bearish it is for the market. So right here, we'll use the red line. So I'm going to right from the start here, and I'll go to where we finish the period. And when we start to roll back over the other way. Here, we just kind of went sideways, didn't really do a whole lot. This one, kind of the same deal. This one, pretty much the same deal, just not a whole lot. Remember, we're in a secular bull market. And so then this one, we were here when it started, and then of course we went all the way down to there, but here's where we are right now, down about 15%, 16% from where we were when this really started to turn back to the upside. All right, now, so that's giving us the bearish, when we get to the bottoms, and this is where we were when we started 2022, by the way. We were at the bottom. That's one of the reasons. This was, I would say, the primary reason why I was so bearish going into this year. Look at where the readings are. 0.46, 0.47 over the course of a year, moving average, way below anything we've ever seen. Crazy bullishness in the options world. We needed to reset sentiment. And so I pointed out, as we broke out here in early January, this needed to go back up. Well, how do you get bearishness? You don't get bearishness with the stock market going up every day. You get bearishness with the stock market going down, with a cyclical bear market. That's how you get bearishness. Now we've gone all the way back up, and now we're just simply waiting for that top. I think the top is here, basically. And by the way, I didn't mark it, but if you go back and you look at all these green points, here was the green point. We didn't go to the red point until over here. This was the rally as we were coming down in this ratio. Here was the rally as we were coming down. Here was the rally as we were coming down. Here is the rally as we were coming down. Here was a rally as we were coming down. This isn't rocket science. It's not 50-50. It works every time. When you come down here and you reach a level of too much pessimism, the stock market, or too much bullishness at the bottom, too much bullishness, it's tough for the market to go anywhere. We're either flat or we go down while this is rising. 2022, while it was rising, we were going down a lot. When we hit the green vertical dotted lines right here, too much bearishness. Now, everybody who wanted to sell has sold. So as we start coming down, we start seeing the market rally. And this is what we're looking for now, is for this to roll over. I think it's about to roll over, and this is the reason why. Here's a 2-year chart on the daily CPCE. Here's that resetting all of 2022. Look at how that's moved up. Right? Well, we bottomed right here in November. Where are we right now? We're in mid-November. So if the market, if I'm right, when the market starts to go up, we're going to start seeing these put-call ratios go down in November and December, just as we saw these put-call ratios at the end of 2021 going higher. So we're going to be going higher here. These are the numbers we're going to be losing. And then as these numbers start to come back down, we were just down 0.55 recently. I think we're going to go down below that fairly soon, probably next week, but we'll see. Maybe the week after. But anyway, when this comes back down and we start getting down into these low 50 readings, they're going to start getting replaced by higher readings. What's going to happen? or these are going to replace the higher readings. So what happens? What happens is you're going to start to see this top. You're going to start to see it level off, just like we saw over here, maybe form a little peak here. And when you see that little peak, it's game on for the bulls. I mean, I think we're already starting, but when we really get going, it's going to be fun. And move on. I want to go into earnings spotlight. I wrote an article a couple of days ago on Walmart versus Target. So I just wanted to show you a couple of charts of earnings that have already come out first. So here we've got Walmart came out with earnings, went higher. We had nice relative strength in Walmart versus broadline retailers right here going into the report. Now I want to show you Target. Target got hammered after its earnings came out, went down. Look at the relative strength of Target for the last 5 or 6 months. Now, we did see a little bit of movement here to the upside heading into earnings. I think it was a little head fake going up to test resistance. And then the carpet was pulled out from under the bulls and back down again. I wrote in the article, I thought Walmart would have a good report. I did not think Target would because of the relationship. And then I pointed out the one I liked the best was TJX. Look at TJX yesterday after earnings came out. Another big move. 80 line was strong. It is one of the strongest stocks. Actually, it's actually in the apparel retail. So let's just make sure we get the relative strength there on that one right. So this is versus apparel retail, but it's one of the strongest apparel retail stocks. And apparel retail has actually been very strong. So it's a leading stock in a leading industry group. And that gets back to what we're looking for in our portfolios. Stocks that do this. That's the way you outperform the S&P 500. All right, current earnings. Let's go through here really quickly, just a couple of them. NVIDIA, show you the reaction this morning. They reported last night. And right now, NVIDIA down $1.13, 157. Cisco reported yesterday. Cisco up almost 4%. And then this morning, we had BJ's come out. This one looked pretty good to me going into its earnings report, and it is up 3%. And then Kohl's did not look so good going into its earnings report. It's down 3%. Three you must see real quick. Let's just do a couple of the Dow stocks. First I want to show you long-term chart, IBM. Look at this sideways action. We're just breaking out above 10 years of consolidation. I think that's noteworthy. Cisco reported earnings, like I said. Here's a long-term weekly chart. Still downtrending, but we do have a positive divergence on the recent lows. I'm expecting the 50-day moving average. And then the last one, how about we take a look at Apple? Apple long-term, just been sideways consolidating. You know, we get caught up in the daily back and forth, and Apple's been weak, so forth. Long-term chart kind of smooths things out a little bit. Been strong. It's been sideways consolidating. The PPO is back down below the center line on a weekly chart slightly. I mean, if you look back at history, when that happens, buy. That has been the buy signal for Apple. So just wanted to point out a little different story there. All right, that's it for me. Again, we got the event tonight, 5:30. If you want to check that out, go over to earningsbeats.com and start your no-cost 30-day trial. We'd love to have you. Also want to mention that I will be back with my next Trading Places Live episode on Monday morning over at Earnings Beats. You can go over to Earnings Beats between about 8:45 and 9 o'clock. The show starts at 9, and click on Trading Places Live. If you click on that, there will be a link. If you get there too early, there won't be a link. It'll show a recording of the last show. So you need to make sure it's between about 8:45 and 9 a.m. There should be a link to come in and listen live. Have a great day, everybody. Enjoy your weekend, and be careful with options expiration week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.